Today, what we're going to be talking about is how the money moves around, especially in the real estate property market, right? From those who have it, the lenders, to those that need it, the buyers or the borrowers, right? And I really want to take this time to explain everything that goes on in the lending industry because that's going to affect. I mean, when my daughter grows up, I wanted to have some basic knowledge about this, what's going on in the back end. Because if she's going to go buy her home, I want her to be well prepared and well informed, really. And I'm going to look for different ways to explain the real estate finance market in very simple ways so that even a 10-year-old kid can probably understand it. And if you have, and I'm just experimenting, right? I've been interviewing people for past 3 years, and I wish there were just someone that would sit me down and just explain things without all the jargon, with analogies that I can understand from a layman's perspective. So we can actually understand it, right? And part of my way to master the information that comes across my table is I have to learn how to teach it. If I can't teach it, then I can't truly master it. So I'm gonna do a couple things today. So the first thing I'll do is I'll make sure I'll cover, hey, where do all the sources come from? Where do the funds come from? Then want to talk quickly about the secondary market. What does underwriting mean? Because underwriting is really a big word. Sometimes people refer to it as, hey, the underwriters had some questions, right? What does that mean? Well, then we want to talk about some disclosures that you might see. And I looked up some of the top questions about real estate financial institutions. And I'm going to cover, hey, why do some lenders just ask for so much paperwork? It's a lot of work when you're about to borrow some money. And then finally, how do you choose the right place to borrow from? That's a huge, huge question. And it can save you a ton of headache if you have that thought in mind. So let's get into it, right? So let's first talk about the major organizations that handle the funds, how they operate, what rules they follow, and some of the documents that you might have to share with them and some of the documents that they have to share with you. All right, so let's start. So when I think about financial institutions, right, I'm trying to think about like, what's an analogy. And again, leave a comment down below if you have great analogies that you think I can use to educate or share that with my daughter. Now, maybe think of it as a, hey, look, there's a giant cookie jar on the kitchen table that everyone in the family can use. Some members can add the cookies, but obviously there are some people that will take the cookies out. And in real estate, that cookie jar is like a pool of money, right? The lenders are going to collect the deposits in it or investments and then lend chunks of it to people that are buying property. Now, the buyers that are expected to pay the lender back, in this case, the cookie jar, back with a little interest. So if everybody pays a little back, pays something back to the cookie jar eventually at some point, then technically the cookie jar should never run out of the cookies or the goodies, right? Assuming everybody pays it back and pays it back on time. So that's how I think about it as, especially from a kid, how else to explain like this whole freaking market of all these different parties having money coming in and money coming out, right? Because banks take deposits and they loan out that money to make money on a money token. Right. So now let's talk about the different types of funding sources. The first one is going to be sort of your neighborhood bank, right? Think of it as plays as maybe your grandparents, they might keep a savings account in a neighborhood bank. And these institutions typically lend to people who show strong credit and stable income. And they handle a lot of services like giving you checking accounts, saving accounts, and their home loan criteria in terms of what their appetite is for loaning out their money, it's usually on a moderate to strict level. Then there are credit unions. You might have heard of the Navy Federal Credit Union. There's just so many different credit unions out there, and these are member-only clubs. And you have to join these through either an employer or community or some kind of status through some other type of affiliations. But typically, they will give you friendlier interest rates to their members, trying to help them buy a house or refinance their loans at more competitive prices. Then there are mortgage brokers. Mortgage brokers, they don't lend their own cash, but they sort of act as matchmakers. They see a borrower, they see a lender, and they try to fit those two pieces together to get both sides what they're looking for. So they typically talk to various lenders. When you go to find a broker, they're gonna go reach out to all their funding partners to find you a deal as a borrower. Sometimes that results in better terms because they shop around, but sometimes that could lead to a ton of work on your end because now you might be answering the same questions in just a slightly different flavor for 5, 10 different lenders. So it could be a lot of work. Just be aware of that. Then we have private groups, or it could be private money lenders. You might hear that term a lot. And I mean, just picture a group of friends who say, hey, we got extra money. Let's lend it for real estate. And these private lenders, they typically offer quicker approvals because they don't have an extensive underwriting team sometimes, right? It might be your family, honestly. It might be your neighbor, it might be a coworker. But they typically charge more interest than your conventional banks because they're taking a bigger risk, right? Because they don't have as many underwriting resources as part of their full-time team. Then there are government supported entities. And these folks typically help people get loans with more flexible rules, especially if they have smaller down payments or if they have a unique situation. And they are trying to keep the cost a little bit more stable for folks that might struggle because of the credit score, credit history, or the lack of a down payment. That, especially if that borrower is going to a typical bank who will have very stringent underwriting requirements, then that could be a situation where a government sort of backed entity might have to come in and provide a better loan product. Okay. Again, if you guys have any questions, please leave a comment down below. I'm just looking for better ways to explain these things. So then we heard about the secondary market. And this has happened to me a few times. So after let's say you're buying a home for your primary residence, you buy the property, you close on a loan, but then the place that lent you the money, might sell your loan to another institution, meaning they can sell your loan like it's a Pokemon card, like a trading card, just to another institution. Now, this frees up their initial cookie jar so that they can go help out more folks, they can recapitalize themselves. But it could sound complicated, but for most borrowers, it doesn't change day to day, right? The terms you have typically will stay the same, but you might occasionally get a letter saying, hey, your monthly payment address has changed. So you got to start updating your direct deposit with this new login, creating this new account with this lender, right? You could have had a loan with Bank of America and all of a sudden it's sold to Chase, just making it up, right? So, what's a good, oh, this is a good term. You should know what a servicer is because a servicer is a company that collects your monthly payments or your funds and they manage your account once the mortgage is sold. So, especially if you go from one servicer to another, you might be setting up direct deposit with a servicer that kind of handles your funds and pays the appropriate lender. So every lender might have different type of stipulations. So just be really, really clear that you understand who is your lender, who was your broker, who is your servicer, because you got to keep all these different roles and responsibilities in your head straight. All right. Now, another term that we talk a lot about is underwriting, right? What is underwriting? And underwriting is really like a lender's process of deciding if you're trustworthy enough to receive a home loan. I mean, imagine your teacher asks you for your report card, your homework, your test scores before they let you join a special club, before they let you sign up for an advanced class, because they want to check on your reputation, make sure that you can succeed and you're trustworthy. And the underwriter does the same thing, right? For a loan, they want to examine your credit, your job record, your savings, your properties details, and everything checks out, then you're good, right? But if something seems risky, they might ask for more evidence, supporting documents, or they might even charge a higher fee or high interest rate because they might view you as a riskier borrower, especially if you have a lower credit score, blah, blah, blah. It just depends on what their criteria is. So just be really aware and be really understanding that, hey, their job as a lender is to not lose the money that they lent out. They have to get repaid. Otherwise, you're going to get a really, really bad. I mean, you can't stay in business if all your loans keep defaulting. All right. So talked a little bit about disclosures. We talked a little bit about the loan estimate. And the loan estimate is really important because you have to be able to preview and see what the cost is for the funds that you're borrowing, right? It should show the projected rate, the monthly obligations, and any upfront fees. Then when you're getting close to closing, right, there's probably some as a final statement of charges. And right before you lock everything in, you are supposed to get a clear breakdown of every single fee, right? And that essentially ties and sums up to the grand total. All right, so those are going to be really important. And obviously, if you're in a specific state or specific city or county, there might be extra local notices that you get. So just be aware of them. And I want to hit on a point that we covered the last couple of days, right? Especially when you talk about what's legal, what's not legal. I mean, every single charge that you get, it should be explained so that there are no surprises. It's never okay, especially if someone's trying to hide a fee or a interest rate bump, so that the buyer doesn't catch it until it's too late. I mean, that's just not good business ethics in general. So just be aware of that. But honestly, you as a borrower, it's on you to also read through everything. You have to understand what you're getting yourself into. You have to read all the disclosures. All right. So now looking at my notes here, why do some lenders ask for so much paperwork? Great question. I mean, they're looking for as much documentation to verify that you're going to have the ability to pay back the borrowed funds. So if you're depending on your income to pay for your mortgage payment on your home, they're going to verify, hey, how much are you making each month right now between you and your spouse if you're married, so that they can see, hey, how much debt do you have and how much do you make, and does that borrower or these two co-borrowers make enough money to make their monthly payment and not be stretched too thin where they don't have money to buy food, right, and put food on the table. That doesn't make any sense. So that's what they care about, debt to income ratio. And it's almost like if you like let a friend borrow your stuff, right, you probably only want to let them borrow your stuff if you are sure that they'll return it, right? If they're trustworthy enough that you trust that they'll take good care of your stuff if you let them borrow. Same thing for a lender. If you're going to borrow their money, they want to make sure that you're going to be responsible and you are going to return that money. So that's why they check job records, credit histories, credit scores, credit reports, what do you want to call them? Bank statements. I mean, that's how they reduce the odds of a default from a borrower, right? They have gone through hundreds of thousands, not millions of files of borrowers, and they probably have figured out, like, hey, in general, folks, these type of folks with this type of data points might tend to default more often than not. And again, this is not investment advice. It's not legal advice. It's not investment advice. I'm not soliciting any phone investments on this Zoom, on this live stream. I'm just trying to figure out an easy way to explain what has typically been so hard for so many people to grasp. And I know my analogies aren't perfect. So again, leave a comment down below if you have better analogies. All right. Then what's the other top question? Okay. How do I choose the right place to borrow from? This is so important. And I have learned just through experience. I mean, I've had my offer accepted over other offers because of who I got my pre-approval from. Right. Sometimes agents, lenders, brokers, they might have a pretty good idea on who's really easy to close with, who's very difficult to close with. When might this lender let the loan fall through because of some underwriting requirements? I mean, so for you, yeah, you should shop around. You should look for rates, right? Some might offer a lower payment, and that might save you money each month, right? Check the closing expenses because a lower rate might come with higher upfront costs. They might call them points. They might call them origination fees, and you have to understand for yourself, especially if you have friends that have borrowed money from a bank or a lender before, what their experience was, what the closing experience was, how difficult was it, right? If they're super slow and you have an expectation, especially in your offer, to say I'm going to close it within 30 days, but the bank or lender can't move fast enough, that might put you at risk of losing your earnest money deposit. Don't take that lightly. All right, so shopping for a lender, I mean, it's just like if you were shopping for a big car or a big ticket item, you're going to want to read reviews. You're going to want to do your research. You're going to want to get referrals. You're going to want to hear feedback from other people. Don't think of this as anything else. I mean, just because you borrow money doesn't change the fact that you are still shopping for a service provider. and you want to make sure that they are going to be able to deliver on what they say they're going to deliver. It's so important. And once you find those folks that say and do what they say they're going to do, hold on to those because those are tough to find. All right. So, lastly, we talked about the pitfalls, right? We talked a little bit about pitfalls yesterday, but don't do yourself any disservice by shuffling around funds, commingling funds, and or doing a quick chop change before you close on a loan. It's just that can just spook a lender, right? Don't skip on reading disclosures. If you're not clear on a specific fee, just ask them what it is. Sometimes there are certain fees or appraisals where they say, hey, you can shop around for this. And it's up to you on whether or not you want to take advantage of it. But you deserve to understand the line items, especially when you're taking out a big loan. All right. And again, we talked yesterday about, please, just a reminder, don't go start a new credit card line. Don't go buy a car when you're about to close on a new property. It just doesn't make sense. Okay. So there you have it. We talked about the major funding sources, the way loans are bought and sold, and some of the documents that you should expect to be able to read over, along with the top questions. I think most importantly, if you can just take away one thing, right? Ask around, find that reliable place, that reliable lender that you can borrow from, because that can save you big in the long run, not just in terms of just financial savings, but also just the time, the headache, the energy that you spend, especially you're working with someone or a lender that is just difficult to work with. All right. So if you found this video helpful, please make sure you subscribe to the YouTube channel, youtube.com/@Kent_HE. I really appreciate you all. Thank you so much for supporting the Affordable Housing Podcast. Without folks like you, I would never had the home I grew up in. So I appreciate you all giving me the time of your day. I appreciate you all helping me come up with analogies so that I can learn how to become a better dad and teach my kid all these different and difficult concepts about real estate and finance in the world. So I appreciate you all. I'll see you back tomorrow for day 523. Thanks for watching. I'll see you tomorrow.